Welcome to the first video of my channel. Today, we'll discuss about Indian Energy Exchange. So first, let us see the trends in the electricity generation capacity in India. So as you can see, from March 2009, the capacity has increased from 148 gigawatts to 356 gigawatts in March 2019. So if we see the sector-wise growth of the installed generation capacity, you can clearly see the majority of the growth has come from the private sector. The private sector has grown from 23 gigawatts to 164 gigawatts in March 2019. So you can clearly see there's a more increased focus in efficiency and profitability. If we see the power supply position in India, the deficit has decreased from 11.1% to just 0.6%. So you can clearly see India has come a long way. This is a really interesting table in which we can see the difference between the average cost of supply and the average revenue of state power utilities. Revenue as a percentage of cost is just 78%. So this 22% gap has created great distress in the distribution companies as well as the generation companies, which we'll learn more about in the next slide. In this picture, we can see that distribution companies have a total of 82,000 crores of outstanding amount to the generation companies, which has brought the generation companies in great distress. Also, the distribution companies have accumulated losses of 28,000 crores. In the latest 20 lakh crore package, the Financial Minister of India has announced that the REC and PFC will lend 90,000 crores to the distribution companies so that they can pay back to the generation companies. Now, this is a really welcome stress, but the industry will have go through many structural changes so that it is investment worthy. Now, let us learn how the electricity is traded in India. First, the long-term electricity contracts, then the short-term electricity contracts. Long-term contracts are for a duration of up to 25 years. So these contracts are generally on a cost plus basis, which means the generation companies will get a fixed cost plus a margin that is fixed at the time of contract. So these contracts don't bring much efficiency in the electricity generation. Then the short-term electricity contracts. So these contracts covers contracts of less than a year, and there are many parties included in this. We will learn more about it in the later slides. India's current market design has led to significant underutilization of cheap resources and overutilization of expensive resources that creates stressed assets. So under this process, it is possible that a relatively cheap generator who has contracted with one distribution company may not be running. At the same time, another distribution company that needs additional power has no way of knowing that this cheap generator is available and will end up using relatively expensive generator with whom it has a contract. The second distribution company is paying a higher cost of power. The inability to assess all the generation in the country and its marginal cost is a major barrier to minimizing the cost of power. In this slide, I have enlisted some reasons why the distribution companies and the generation companies will prefer short-term power over the long-term power. The government has decided to phase out 25,000 megawatts of old generation thermal capacity, which will be replaced with new capacity, and it is expected that this capacity will be traded in the short-term market. There are no new contracts made on the long-term side because of the uncertain future demand. Also, the electricity that is traded on the short-term market is much cheaper than the contracted prices because of the heavy sell side volumes. Uh, Power exchanges also give the distribution companies an opportunity to reduce the overall cost of sub power. With the help of this pie chart, we can see to almost 88% of the total traded electricity is traded through long-term transactions, and the rest 12% is traded in short-term market. There are various parties in the short-term markets. First, the bilateral transactions through traders. Then the bilateral transactions directly between the distribution companies. Then there are the power exchange transactions. Then transactions through DSM. We'll discuss more about DSM in the later slides. Now, let us see the volume of short-term transactions of electricity from March 2010 to March 2019. The total volume of electricity transacted through short-term market has increased from 66 billion units to 145 billion units in March 2019. Also the market share has increased from 9% to a 12%. So in the short-term market, the power exchanges have a 37% market share. The 17% of the market is transacted through the deviation settlement mechanism, and 32% by direct transactions through traders, and just 13% through between the distribution companies. Now we'll discuss about the volume trends of the each of the parties in the short-term market. So in this table, we can see the electricity transacted through traders has increased from 22 billion units to 47 billion units in 2019, whereas electricity transacted through power exchanges has increased from just 3 billion units to 53 billion units. In this bar chart, you can clearly see how fast the power exchanges have taken away market share from the traders. And in the later slides, we'll also discuss how the longer dated contracts will help the power exchanges to gain more flexibility and take away more market share from the traders in the future. Now, let us discuss about the deviation settlement mechanism. We need to know that the deviation settlement mechanism is not a way to trade power, but it is to ensure grid security because of the differences between the contracted volumes and the actually metered volumes. So this mechanism attracts lots of fees and penalties to the distribution companies. It is not the most preferred way to draw electricity from the grid. In this table, we can see the volume transacted through the DSM has stayed same from March 2010 to March 2019. And the volume of the DSM as a total percentage of short-term market has decreased from 39% to 17%. Now, the third way in transactions of the short-term market. You can clearly see in this chart that from 2012, there's not much increase in the total electricity volumes transacted directly between the distribution companies. So we can clearly see that this way is not the most preferred way to transact electricity. Now, let us discuss about the products offered by Indian Energy Exchange. First, the day-ahead market. In the day-ahead market, electricity is traded in 15-minute time blocks that is to be executed in the next day. So this gives the distribution companies a flexibility to adjust the cost of power. Also, to plan for the excess electricity that will be needed in the next day. Then the term ahead market. It is the most flexible way to trade power. Contracts can be intraday to two periods of up to 11 days. Then the renewable energy certificates. This is to ensure for huge industries to comply with the renewable power consumption requirements to the obligated entities. Then the energy saving certificates. These certificates are issued on accomplishing targets for reduction in specific energy consumption, which are then tradable on the power exchange. Now, let us see the new products that are offered by Indian Energy Exchange. First, the real-time market. It was launched on 1st June, and in this, the power trading will happen just 1 hour in advance, and trading will be done for 30-minute times. Also, then the longer duration contracts. It is still in the pipeline, and in this, the power trading will happen for contracts to be executed after 3-4 months. So the longer duration contracts will give the much needed flexibility to the power exchanges. Now, let us see the market potential of each of the new products. First, let us discuss about the market potential of real-time exchange. So as we know that the distribution companies can buy power just 1 hour in advance in the real-time market. So that will help them to avoid the fees and the penalties that they incur because of the deviation settlement mechanism. As we know that the deviation settlement mechanism has a 17.3% market share in the short-term transactions, which the management expects to take away most of it in the near future. Then the longer duration contracts. The longer duration contracts give the much needed flexibility to the power exchanges. Because of that, they'll easily take away more market share from the traders and the transactions that are done directly between the distribution companies. Open access consumers refers to those consumers which prefer to buy from power exchanges instead of the state power utilities. As we know that Indian Energy Exchange has a market share of over 95% in the total short-term market. Most of the open access consumers prefer Indian Energy Exchange because of the liquidity and the prices that it offers. Now, let us have a look at the growth of the renewable energy certificates transacted on the power exchanges. From just 1 million units in March 2012, the number of RECs transacted has increased to 12 million in March 2019. Also, we can clearly see because of the less sellers compared to the buyers, a lot of demand is being unmet. In this table, we can see the product-wise growth in annual volumes of the day-ahead market, term-ahead market, and the renewable energy certificates. We won't be discussing about energy saving certificates because it doesn't give significant volumes to the power exchanges. We can clearly see how fast each of the segments of the power exchanges are growing. In this slide, we can see the increasing sales and the profitability trends of the company. We can also see a significant part of the income comes from the treasury income, which is not sustainable because of the decreasing interest rate trends in the country, which I believe will be easily compensated because of the increasing operating profits. Also, we must not forget the company has launched its own gas exchange known as the Indian Gas Exchange, which, because of the scalability capability of the company to scale products, I believe it will be a significant contributor to the top line and the bottom line of the company. The company is available at a market cap of 4,900 crores. The company enjoys healthy return ratios because of its asset-light model. So every increase in the sales directly contributes to the profitability of the company. The company also has really strong cash flow generation capability. Because of that, the company gives out most of its profits through dividends. Also, the company is available at a price to earning ratio of 28, which compared to its peers, which are other platform businesses, is reasonable, like MCX and India Mart. Also, we must not forget the company is least affected because of the lockdown. The electricity consumption has come back to its pre-lockdown period. Thank you for watching the video. I hope you like it. Please subscribe for more videos in the future.